I hear a lot about a conditional pause. And Tony, I want to know what it's conditional on and whether the bar for hikes is higher or lower than the bar for cuts at the Fed going forward from here.
Well, good morning, Jonathan. Good to be with you. And we do think the Fed is one and done. We don't think they're going to state that clearly because we do think the bar is still higher for cuts. Right now, the Fed has an inflation problem. As we look forward and we look towards the back half of the year, we do think you'll start to see economic weakness flow into the economy here. Tighter lending conditions, we think, are going to be one of the key drivers. But the evidence of that is still not clear enough to the Fed versus the evidence that inflation is sticky, it's much higher than their target, and their belief is that they need to at least pause at this new higher level, in our minds, for the balance of the year. So that means that the bar for a cut is higher than what the market is currently pricing in.
This is the question we've got to ask, Tony, off the back of the banking stress of the last month. We've got to work out what kind of economic outcomes do the bank failures lead to, and ultimately how quickly those outcomes will materialise. How long will this take? What are, so to speak, and I've asked this a few times, Tony, the long and variable lags of a banking shock?
Well, Jonathan, there are long and variable lags, as you mentioned. We certainly are seeing that now with the bank balance sheets and the impairment to their asset side of the balance sheet. And that's what really, was a big part of what drove some of these failures. In terms of seeing it flow through the broader economy, we came into this with a very resilient consumer, with a very resilient corporate balance sheet. So in our minds, it is going to take longer to flow through. That's a strength we're seeing in a low unemployment rate. But as we look forward to the end of the year, our view is that you are going to start to see that. Our view is that we'll see a mild recession. It's likely to kick in early in 2024. At the very earliest, we'll start to see signals of that in the fourth quarter. That is what we think will eventually lead the Fed to start to shift to cutting rates early next year. But whereas the market is pricing a September cut, for example, we think that's way too early. And that's because the economy is going to be a little more resilient because of a strong consumer, and inflation is going to be a little bit stickier than what the Fed needs to see in order to be able to pivot.